what he's talking about is the cash flow statement. So this is one of the financial statements that companies must release, and they disclose all of the information about their company in these financials. And the cash flow statement is going to tell you where the cash is moving. So there's three sections to that, like Adam mentioned in the question. There's cash from operations, there's cash from investing, and cash from financing. So he mentioned companies with negative cash from investing and cash from financing. That's actually not a terrible thing. So cash from operations would be anything that has to do with buying your running your business. So let's say we had a lemonade stand. It would include the working capital we had to do. So that would be cups, ice cubes, pitcher,
Lemons.
sugar, water. What did you have?
Lemons.
Lemons. I guess we could do lemons for lemonade stand.
Just a thought.
Thanks. So that would be part of it. We would have to pay our workers. That would be part of it. That would be on the income statement. And so all of that goes into operations. And then, you get the money that comes in and pay the suppliers, and then you have the cash that's come in from that. Now, do you want to grow? Do we want to open 2 lemonade stands down in the couple cities next to us? Well, in that case, we're not just talking about buying cups and pitchers. We're talking about units. So
equipment, land,
yeah,
building, all that stuff.
All that stuff. I guess maybe I should use like a store as an example, because a lemonade stand doesn't sound too expensive it wouldn't be much of an investment. But yeah, so I mean, if it was a store, similar thing, right? These stores would be huge investments. So that's where cash from investing comes in. So when you're growing your business, or even if you need expensive machinery to maintain the business, those tend to be paid off in multiple years. You don't just pay it off in 1 year. They're long-term investments. And so that's where that cash goes. And then cash from financing would be, did you take debt in, or did you pay off debt? And so I think dividends and share buybacks, those also go into cash from financing. So you could have a company that's paying out dividends and they would have negative cash from financing. And that's a good thing, because if I'm a shareholder, I want dividends from my company. So those are kind of the 3 main parts of the cash flow statement. And a lot of focus goes on that top part, the cash from operations, and with good meaning too, because you really want to know what's going on in that individual unit of our lemonade stand. Did we sell more lemonade? Were we able to raise prices on our lemonade? Did we offer new products? And then those things all show up in that statement, and then it kind of flows into the rest of the picture that becomes cash flows and earnings and profits and stock prices. So that's kind of how I look at those parts of the cash flow statement. Was there something that you saw I missed?
I don't think you missed anything. I think the thing that I try to think about when I think about the cash flow statement is, it's a little confusing because the way that they list them in the financial statements, the 10K or the 10Q, the annual or the quarterly reports, is it's always listed last, but it actually sits between the income statement or the P&L. Then you have the cash flow statement, and then you have the balance sheet. So the income statement kind of flows into the cash flow statement, which flows into the balance sheet. And the balance sheet, you have to think about that as a snapshot in time. It's not a living, breathing document. The cash flow statement and the income statement are, because those are things that they update on a regular basis, and things are moving in and out. Whereas the balance sheet is something that you show the financial position of the company at that particular time that they file the report. And so you could think of the cash flow statement as kind of like the checking account, if you will, of the business. And it's really about the money that goes in and out of the business to allow the business to operate. And Andrew did a great job of explaining all that. And the cash from operations is really the lifeblood of the operations of the business. So like Andrew was saying, you got to pay for everything to operate the business. The cash from financing is how the business finances itself to make sure that it can continue to grow, however that may be. And then the cash from investing is the money that you use to grow the business, where the financing is really kind of thinking about how they make up the gap between the cash from operations and the cash from financing or from investing. And so the cash from financing is really whether the company has to use debt to to have enough cash to pay for the things that it's trying to do, whether it's from operations or whether it's from investing. And the other side of that is whether it has to raise equity to pay for those things as well. And you also see things on there like dividends and share buybacks and all that kind of stuff. But the top one, so the cash from operations, you generally want to see that positive. You will see that negative from time to time, and that's depending on the life cycle of the business. That's not unusual. But when you start seeing the other ones as positive, that's not necessarily something you want to see. Because if you have a company that's growing, you want to see them putting money back into the business. And you want to see that negative because you want to see them using the money that they're generating to invest back into the business. Because if they're not, then it's not unusual to see it positive for a quarter or a year, but if you see that on a consistent basis, then you have to ask yourself, what are they doing with their money? How are they growing the business, and what point is this business at their normal life cycle? And I'm going to use Visa as an example. So I was just looking at Visa's financial statements before we came on tonight. And the cash from investing for the company in 2020 was actually positive. But the 2 years prior to that, they were negative. And if you look at the cash from financing, all 3 years were negative because they pay out a ton of money in share buybacks and dividends. So in other words, they're taking a lot of the money that they make and they're giving it back to the investors in those forms of whether it's a dividend or a share buyback. And that's how the company uses the money because they have limited, because of the nature of what Visa does, they have limited need to reinvest back into the business as much as somebody else might. Microsoft has to, Intel has to, Google, they have no choice because of the nature of what they're doing. They have to. But Visa is kind of in a unique position where their business is, they can operate, they can turn the lights off and the business is still making money because it's just kind of the way it works. But I think when you're thinking about analyzing companies, you have to think about several things. Number one, you need to think about where's the business in the life cycle. In other words, is it a young business? Is it an old business? Is it in a new kind of sector or niche, or is it in an old, more kind of reoccurring, the grocery business that's been around for 75 years? Their capital needs, in other words, the money they need to reinvest, is way different than it is for somebody that just went public 2 years ago and they're in fintech or they're in cloud computing. There's a lot more money they need to spend to continue to grow. So all those things you have to take into consideration when you're thinking about analyzing this, but it's not unusual to see some of those negative. And so even if you see it trending downwards or upwards, those are just things you have to look at, especially on a quarter by quarter basis. You have to kind of think about that. But hopefully that helps answer that question a little bit.
Yeah, I imagine it probably does. To add on to what you said about trending, I would want to see cash from operations trending upwards. But like you said, it can fluctuate, and that depends on what kind of investments they make. And so that goes for the investing and the financing too. I think you covered it really nicely with the financing, and like you said, if it's positive, it's just they're like accumulating cash. Like, what's the point? The business is supposed to give the cash back to the owners, not just stockpile it for no reason.